Hi guys and welcome to the trading show. This week we are gonna talk about
Market 2020, historic year for Bitcoin, our portfolio 45% in 2020, and the performance of our signals.
And if you are interested in systematic trading, then subscribe to our channel. I am Francesco Placci, Head of R&D at Unger Academy. Let's start from the market overview to see together what happened during the week. Hi guys, this is the last episode for this year, so we can take stock of the situation of market trends for 2020. So let's start from the stock indices. In this chart we see the Nasdaq future that managed to close 2020 with an incredible 47% return despite the drawdown due to the pandemic that took place between February and March. I remind you that the drawdown experienced this year was particularly fast and intense, around 35% for American markets and almost 50% for European ones. Then the mini S&P with a 16.5% return, while the European markets are essentially unchanged, with the Euro stocks with negative returns. However, these are astonishing performances because since April, in the absence of a vaccine and in the midst of the economic crisis due to the generalized lockdowns, we have witnessed a significant recovery in stocks prices, basically generated by the very big injection of liquidity that was carried out by central banks. It was a V-shaped recovery, and frankly no one among economists and traders imagined anything like that. If we take a look at the trend of volatility in that period, we find the values close to historical highs. In particular, the yellow line, which represents the trend of the VIX index, reached the value of 82.5, very close to the historical highs of 2008. So, despite the crisis and the fear present on the markets, represented by the VIX index, the American stock indices managed to fully recover the drawdown and close the year with positive performances. As regards the bond market, also in this case we see positive performances, in particular for the T-bond. The energy sector, on the other hand, has experienced a great crisis. We have seen oil with negative prices, which was quite unthinkable in advance. The returns range from a minus 22% of crude oil to minus 38% of natural gas. Very strong instead the metal sector, in particular the silver, which had a 43% return year to date. Anyway, all positive, platinum, copper and gold. Slightly positive returns for MITs, ranging from minus 7 to minus 5%, while all soft commodities are positive, with the only exception of coffee. The cereal sector is positive too. Returns are positive at 5 days, 1 month, 3 months and year to date. In particular, soy and its derivatives, as you can see from this chart, are in strong uptrend. As regards currencies, we have a very strong EUR/FX, which has grown by 8% years to date, and an equally strong Australian dollar future. However, in general, the whole currency sector shows positive returns. And finally, the real star of 2020 is undoubtedly the Bitcoin future, which closed 2020 with a 216% after a start that was not so good. Anyway, from March until today, it entered in an incredible bullish trend. We'll see, however, during the next year, if it will be able to confirm all the expectations that are present for the whole cryptocurrency sector. To conclude, the main fact that made this year unique in the financial field of the recent years are the strong drawdown of the markets due to the pandemic, the consequent spike of the VIX index, negative prices for crude oil, and the cryptocurrencies sector that looks set to grow further. Greetings to all and a Happy New Year from Francesco Placci. After seeing some key statistics on financial markets, and given the fact that automated traders also use this data to build their trading strategies, as usual, we will now take a look at our portfolio of trading strategies to see how systems have reacted to current market conditions.
Hi everyone and welcome to this last video of 2020. I am Alessandro Danos, and in this last video I want to show you how our software Titan, that is the software that we use to filter monthly our strategies, has performed during the last year 2020. And we can see that we had put in Titan a list of 385 strategies. Here there are some that are deactivated, like this one on crude oil. So the list contains at the end 370 or 375 strategies. And they are all cataloged by type, so you can see there could be 3 different types of strategies, so a reversal strategy, a bias strategy, or a trend following strategy. And of course these 3 types could be or multi-day or intraday, so they are also cataloged by the time frame horizon. I want to say also that the 90% of these strategies are out of sample. So these strategies have an out of sample of around 2, 3 or 5 years on average. And of course this is really significant because Titan gives the best results with out of sample strategies, because in this way Titan's filter are more stressed, and so the backtest acquires significance. Now, looking at the backtest, we can see that 2020 was an excellent year, with a performance of around 45%, and a drawdown, you can see it here down below, of around 10-12%. We can say that in the first part of the year, Titan showed the best results. So until September, we can say the year was pretty sensational. And then from September we entered in a drawdown. Of course, it's not so big, but if referred to the profits. But of course, this is a part of trading, and so we are prepared. In this list are present many different futures, around 20 different futures, from equity indices futures to metals market futures, energies, and so on, so softs and grains also. And so finally we can be satisfied for sure on how Titan filtered our strategies. And of course 2020 was a volatile year and offered many occasions regarding trades with a positive risk-reward ratio. And so also the assumption for next year are good. Of course, we hope that this drawdown will end as quickly as possible, but for the moment we can enjoy the profits. I take this opportunity to wish you a great end of year and a wonderful 2021.
Hello everyone, today we will have a look to the signals we give into the investing club, and in particular we offer 2 different signals type. The first one is monthly based on ETFs only, and the ETFs are chosen from between different kind of ETFs, such as the QQQ, so on the Nasdaq market. Then we can find also the S&P 500, so the SPY ETF. Then we have the EEF, so the 7 to 10 years US treasuries, the TLT, that is the 20 plus years US treasuries, and also the gold ETF and the diversified basket commodity ETFs. I cannot give you a precise proportion of those ETFs just because we implemented a sort of algorithm that automatically decides the proportions between those different ETFs. So it's not possible, unfortunately, to give so many informations about the ratios between the different components. But by the way, I will show you the results of this asset allocation. And here we have the daily equity curve, and we are comparing the portfolio results with a benchmark that in this case is the buy and hold on the SPY ETF. And we can clearly see that at the end of the considered period, of course, the asset allocation would have earned a bit more money than just keeping the SPY ETF. But the most important thing, in my opinion, is that the drawdown of the strategy, so of the portfolio, is approximately minus 14%, as you can see here in the title of the chart, while if you would have kept for the whole amount of period, so for the entire amount of period, the ETF on SPY since the first day, you would have had a drawdown of minus 55%. And by the way, we talking about the compounded average growth rate, for what regards the strategy and the SPY, it's quite similar, but the main difference, in my opinion, is the drawdown. And we can see here, for example, in the lower part of this chart that shows the percentage drawdown of the portfolio and the SPY ETF, that, for example, during the financial crisis that began in 2008, the strategy would have kept this quite acceptable drawdown of minus 14%, while SPY would have had a significant drawdown of minus 55%. But not only in that phase, because we can clearly see also that in 2019, for example, like here, SPY had an important drawdown of about minus 20%, while the strategy's drawdown was significantly lower here. And also during the pandemic period here, the portfolio would have had a drawdown of approximately minus 12 to 14% about, while SPY would have had a much more higher drawdown from minus 30 to minus 40%. So this is the reason why, in my opinion, it's just better to create a more complex strategy than just keeping a single ETF, like in this case. And if we want to compare also the periodic results of the portfolio with the periodic results of the benchmark, in this case we can clearly see also for what regards this year the main differences. So, for example, in February 2020, the portfolio would have had a gain of 0.18%, while the underlying, so the benchmark, would have had a loss of minus 8%. And the same happens in March. So with this kind of portfolio, you would have lost a very small amount of money during the pandemic period, so minus 0.13%, while keeping in your portfolio the ETF of SPY, you would have lost something like minus 12.50%. But of course, on the other side, when the market had recovered in April, you would have earned much more money by just keeping the ETF on SPY, while you would have earned less money with the more complex strategy. And this is of course because having in a portfolio some ETFs also on the bonds, the volatility on the bonds is significantly lower than on the stocks markets usually or normally. And then of course here you would have earned less money than just keeping the ETF. But of course you would have lost more money before, the 2 months before, while here you wouldn't have lost money at all. And the same discourse, of course, is valid, for example, for the month of November, where the S&P 500 went up quite quickly and quite significantly, with a plus 10.88%, while our portfolio would have earned something like 4.75%. But if overall we would have a look to the periodic results of every year, I would just prefer to trade this kind of portfolio, just because, for example, in 2008, when there was the financial crisis of the subprime loans, and then after the general economic and financial crisis, here the portfolio would have earned the 2.96%, while keeping SPY in your portfolio, you would have lost minus 37% or minus 36.79%. But of course, also in this case, when the markets recovered the next year, you would have earned significantly less with this kind of model if compared to the market. But it's money you wouldn't have lost the previous year, so it's not a problem in general if you trade every year this kind of strategy. A particular year was 2017, sorry, because it had been a year where the markets had raised significantly in all over the year, but with a very low volatility. So you wouldn't have suffered in general during the year. In fact, here you can see there is no negative month on the benchmark in 2017, and you would have earned better if you would have kept the ETF in your portfolio instead of trading this kind of strategy. But the difference is not that much, so it's quite acceptable in my opinion. Now we will have a look to the second model, and the second model is a rotational portfolio on the Nasdaq stocks, so on the Nasdaq 100 index stocks, and also this model has a coverage on the bonds ETFs, and in particular on TLT. Also in this case, I cannot give you a precise ratio between the two components, just because it varies month by month or period by period, and this is just because every component returns is analyzed at every evaluation period, and then the software automatically decides the ratio and the proportions between those different components. But in general, the strategy consists in two parts. The first one is a stock picking strategy on the Nasdaq 100, and I want to point out that this kind of software or this kind of mechanism allows us also to consider the delisted stocks on the Nasdaq 100, and we also analyzed the Nasdaq with the right components at each past period. So we are not analyzing the current composition of the Nasdaq 100, but each time we decide which stocks have to come into the portfolio, so should be traded, we analyze the composition that there was at that time in the Nasdaq 100, and then as a plus we also consider if there was the listed stocks, we considered it into the backtest. So if its price would have gone to 0, we will consider that position as a loss. So now we will have a look to the equity curve, and you can clearly see also in this case the final return is pretty similar to the Nasdaq return, but there are also in this case some important differences. For example, like in the previous case, here in 28 we have a significant difference in terms of drawdown. In fact, here the drawdown of the strategy in this period is approximately minus 15 to minus 20%, while the drawdown of the Nasdaq index was more higher than 50%. Having a look to the precise number, the drawdown of the strategy is minus 16.37%, while the drawdown on the QQQ, that is the ETF on the Nasdaq on the Nasdaq 100, is a minus 53.40%. And also in this case, in the most recent crisis or bad periods, like in 2020, for example, or 2019, we can clearly see that the strategy had a better behavior than the benchmark, and the drawdown is significantly lower also during the pandemic period here. Then I also did an additional test, because with the stocks I was able to go back on a more longer amount of time, and I replaced the QQQ with the Nasdaq index just for testing purposes, and the TLT with the index on 20 plus years treasuries. So I performed this test from 1996, and I was extremely curious about this test, because in my opinion the worst period of the Nasdaq was during the first years of 2000, so of the new millennium, of the new century and new millennium. And the problem here was that so many stocks has been delisted and went really bad. So in my opinion it was extremely important to consider also this period into the test, just to discover how the strategy would have behaved during this extremely terrible period in the first years of 2000, so of the new millennium. And as you can see here, the drawdown of the Nasdaq index had been minus 82.90%, while the drawdown of the strategy had been minus 20%. So also in this case, the strategy would have performed significantly better than the benchmark. Clearly, it wouldn't have earned a lot of money during this extremely terrible period, but overall, the behavior has been quite good in my opinion, if compared, of course, to what had happened on the Nasdaq market. If we have a look finally to the portfolio periodic results all over the years, we can clearly see, for example, in 2000, the strategy would have earned about something like 21.50%, while the Nasdaq index would have lost something like minus 37%, and the two following years, of course, the strategy wouldn't have done significant damages into the portfolio, while keeping the Nasdaq ETF in portfolio would have created significant extremely bad damage to your economy, if I can say so. Also, 28 has been a quite good year for the strategy, while for the Nasdaq had been an extremely bad year. But of course, there are some other cases where the market goes extremely well, like in 29, and the strategy hadn't performed well. But overall, most of the years are positive and with a good and acceptable return. So I would always trade some very good year for a more consistency and a more conservative approach.
Well, let's see together now how the daily stock signal service of our website algoinsider.com performed during 2020. It is a trading signals service that works on the Nasdaq 100 basket. It is based on a swing trading system. Therefore, unlike the previous asset allocation models, it's a timing model that works with mean reverting approach. Trades last on average 1 to 3 days and trading capital is rarely fully used. This obviously depends on the presence of the entry setup. For more information, I suggest you visit the algoinsider.com website, where you will find further information and statistics useful for evaluating the service. The backtest we are seeing together refers to the current year, and the recommended starting capital is equal to $12,500. The system has made a net profit of $3,176 with a maximum portfolio drawdown of just over $1,600, which corresponds in percentage to about 10%. Let's take a look at the chart of the equity line, which has certainly suffered a bit due to these stormy years of the markets. All in all, we can say that the system has done a good job in containing the drawdown, especially in the pandemic phase. In fact, the system contains some filters that deactivate the trading activity when volatility is considered too high. Let's take a look at the equity line close to close with drawdowns. Here we are. We can see how the drawdown in percentage terms has always remained within 10% with a fairly linear trend and a final return of $3,176, which corresponds to a return of 25% on the starting trading capital. Therefore, the final return has more than doubled the maximum annual drawdown. The profit factor of this system is almost 1.7, with a percentage of profitable trades close to 70%. To these results must be added commissions and slippage, which vary depending on the broker. Therefore, we preferred not to include them in the backtest. In any case, the recommended capital cannot be less than $12,500, otherwise the commission impact will be excessive. Taking into account the difficult year that financial markets have experienced, it seems to me a very good result. Well guys, so if you want to learn how to build trading systems like Andrea Unger, the only 4-time trading world champion with real money, go ahead and click on the link below. You will be able to pick a date and a time for a 45-minute call totally free with one of our tutors. We will talk about your current situation, what you are doing in trading and what you would like to do instead. And we will try to understand together if we can help you achieve your trading goals. Finally, if you like this video, press like and then subscribe to our channel. Thank you for watching. See you next week with another episode of the Trading Show.